Hi, this is Jason, Chief Technical Analyst with Toro Alerts, with your weekly market update. We saw a nice move to the upside on Monday, but then some pretty aggressive selling on Tuesday, Wednesday, with a bit of recovery on Thursday and a fairly flat day going into the end of the week. So taking a look at this correction, this could be just a brief correction, looking like a possible wave 4, with possible wave 5 to the upside still left to materialize. As long as we're sitting above the 443.50 level, I'll still be looking for some possible long opportunities in the broader market. I do think it's going to be a fairly short move to the upside if we get it. And if we break down below that 443.50 level, then I'll be getting pretty bearish on the broader markets as a whole. But I think there's still a chance that we could get above these levels and get back up to an all-time high. The fifth wave is typically measured out the same distance as the first wave, which is down here. And if we measure that out, it actually puts us right about to the top at the 477.50 level, which is essentially our all-time high from late December last year. So I think there's a decent chance we can still see one more brief move to the upside with that fifth wave materializing if we do break out of this correction. And that would provide a little bit more upside for the broader markets, but I am preparing for a bit of a correction. It could already be starting right now. If we break down again below that 443.50 level, then I'll be very cautious and be looking to be very defensive and looking for those defensive sectors to get involved with and go into a lot of cash. But if we maintain that and we move up to the upside a little bit more, we could see maybe another week or two upside momentum before we top out. And I think there's a really good chance for a pretty aggressive correction going forward. The Fed meeting coming up in May is really looking like it's got some opportunity to really push the markets down with all the discussions of Fed tightening, interest rate hikes, and balance sheet reduction. And so all of those things are typically pretty bearish for the market. So as we get closer to the May date, if we do see some more upside momentum in the short term, we want to be cautious going into the month of May, as either May or sooner we'll probably start seeing some downside pressure in the markets. Jumping over the NASDAQ, we saw that fall down below a key Fibonacci level, which is about 354. As long as we're below that 354 level, I'm really not interested in going long on anything in the NASDAQ right now. If we can get back above that level, then there might be some more short-term opportunities for some NASDAQ trades, but as of right now, as long as we're below that 354 level, I'm staying broadly away from the NASDAQ stocks at the moment. Taking a look at the Dow Industrial Average, we did see some sell-off in that this week, but we saw a much stronger recovery to the upside towards the end of the week, and we'll be wanting to see next week if we can get above that 348 level. If we can, I think there's a pretty good chance that the Dow Industrial Average could also get back to those former highs before a possible correction. Taking a look at our Dow Jones Transport Index, transportation stocks have really been beaten up aggressively the last couple of weeks. We peaked out at a pretty major resistance level where it's kind of bounced off a few times in the recent past. And 3 or 4 weeks ago, we were actually looking pretty bullish, and then it rolled over pretty hard. And so we are sitting at a pretty key support level at that 14,370, we'll call it. And so if we bounce off of that and move to the upside, there could be some short-term trades in transports, as this has held as a pretty nice support level for about the last year. But if we break down further below that, I think that would be even more signal and warning for the broader markets that correction can be coming fairly quickly. Let's jump over the relative rotation graph and take a look at the sectors relative to the S&P and the broader markets. When we scroll down and look at the different sectors, we can clearly see the defensive sectors have really been outperforming over the last 2 weeks, and that's utilities, real estate, healthcare, and consumer staples. And so it looks like the broader market is kind of already positioning itself to get defensive for a possible correction. And so I think that's also a pretty good signal telling us that we should be somewhat cautious going forward. And if we continue to see those 4 sectors outperform, then I think there's a good chance that a correction is coming fairly soon. And looking at some of the worst sectors we've seen, the cannabis sector in the last 2 weeks is down almost 17%. We've seen autonomous technology and robotics down about 7%, and fintech down about 8%. And so we've seen a lot of red in the markets in most sectors, and again, just the strongest ones being defensives. I think that's a pretty strong signal that the smart money is starting to already position for some rough waters ahead. And when we jump over to the Russell 3000, we talked about last week when we got above that 50-week moving average, that still looked fairly bullish. as long as we can stay above that 50-week moving average, but it did fail this week and it turned back down to the downside, and so that's starting to look a bit bearish even for the broader markets there. And then we jump over the Russell 1000, the large caps, similar story. We got above the 50-week moving average for the last couple of weeks. Was starting to look like it could be some bullish opportunities for some of the large caps. But once again, on the large caps as well, we broke down below that 50-week moving average and closed below it. So we'll watch that next week and see where we go from here. But if we continue to sell off from that 50-week moving average, that's looking fairly bearish for large caps. And then jumping over to small caps, the Russell 2000, we had a very aggressive sell-off this week in small caps. Came up against a real key support resistance level that we've been watching for quite some time at about the 209 level. Rejected off that very strongly and came all the way down to about 197 to 198. And so small caps is looking a bit bearish as well. Then when we look at our Value Line Geometric Index, about 1,700 stocks are represented here in the New York Stock Exchange. We've been watching the 630, 631 level as a key support for some time, and we've been bouncing around that for over the last few months, and we got back above that level for the last 2.5 weeks, but then sold off this week and pretty aggressively got and closed below that level. And so that's telling us also, just like the Russell 2000, that that's looking like in the short term we got some bearish potential activity in the broader markets. We jump over to the Vanguard XUS ETF, the VEU, that represents the stocks in the world minus the United States. Key level we've been watching on that one is 59. We almost got above it last week but rejected off of it, and then this week really sold off aggressively. And so it's looking like the broader markets outside of the US aren't looking all that great either. And when we jump over to the growth compared to value, we saw 2.5, 3 weeks or so of some growth actually outperforming value, which hadn't happened for quite some time, but it rolled over this week pretty aggressively, and we saw value really start to outperform growth. And so I think that's really going to be a trend going forward, is that if there are some opportunities in some of the riskier assets, I think it's likely going to be in the value sector as opposed to growth going forward. And when we jump over the oil pricing for the U.S. oil barrels, we got below 100. We're actually closed below 100, just below $98 a barrel. But we are at a pretty key resistance level we've been watching. These are like Fibonacci fan extensions, and we've been kind of riding this line pretty nicely, and we've still been maintaining to close above that for quite a few weeks. I think probably the corrective phase on this is likely close to over. I still think there's a lot of upside momentum in oil prices as well as the energy sector broadly, but we want to see that start to break and move to the upside again. Probably expecting that to happen fairly soon, and once we see that take off again to the upside, I think there's going to be some really good opportunities once again in both trading oil to the upside as well as just the broader energy sector as a whole. And when we look at our commodity, the CRB index, we had a very volatile last couple of weeks. We had a big move to the upside and then a big move to the downside. It was basically the same movement up and then completely retraced. This week we moved back up to the upside a bit, but it was a much smaller move to the upside. And so we'll watch that going into next week to see where we go. But just like oil, I think commodities are still in a secular bull trend, and I think there's still some opportunities there. But we kind of want to see probably a break from this kind of bit of a bull flag we got forming here, probably before you get back into any commodity trades at the moment. And then we'll take a look at the high yield corporate bond ETF. Last week we got briefly just above a key resistance and support level at about the 8250 level, and aggressively pulled down off of that this week, and just about down to almost the next support zone, which would be 7950. And if we break down below that, I think that would be a pretty strong signal that the markets are probably going to weaken even further. And then the other thing we're watching is the high yield corporate bonds divided by traditional bonds as a ratio chart. And when we look at it and compare it that way, we've been kind of chopping around in a range for some time. But when we did break below this key level, probably about 4 or 5 weeks ago, that was actually when the stocks were selling off pretty aggressively. And so if we get back below that 0.66 level, I think that'll also be a pretty strong signal to get cautious in the market. So we'll be watching that one closely over the next few weeks to see if if we stay in that range or if we actually break down below that 0.66 range. And when we take a look at consumer staples versus consumer discretionary, we can see it's in a pretty clear downtrend, and so that's telling us that consumer staples are really starting to get bought up, as we saw in the relative rotation graph earlier. And so people are definitely positioning more defensively with those defensive sectors. And this graph is showing us, this chart is showing that exact same thing, that we're, anytime this is moving to the downside, people are getting defensive. And so this is a pretty strong move for just 1 week. And I think that's showing us that people are really starting to prepare for potential correction coming up. When we take a look at the DXY, the dollar, we had a bit of a bull flag formation, which is fairly bullish signal. We did break above that and just about got up to that 150 level and sold off a bit from that on the week, but still closed up higher than that bull flag breakout. And so I think the bias on the dollar is still to the upside. It wouldn't surprise me to see us get at least to that 103.85 level or possibly higher. Typically when the dollar goes up, that's usually a headwind for stocks, and when the dollar is going down, it's typically a tailwind for stocks. And so that's another chart that we're looking at that's telling us to possibly be cautious with stocks going forward. And then we jump over to the gold sector and see what gold's been doing for the last few weeks. We've just kind of been hanging out in this range here. Before I probably get back into any gold opportunities, I'd really like to see it break this 186 level before I start looking for some long opportunities. Otherwise, we could just be chopping around in this range between 175 and 186. And so if we're in between that range, I'm just kind of waiting for a stronger signal to decide what I want to do, if anything, with the gold sector at the moment. And then when we look at silver, silver is actually at a pretty key volume support level, right around the 22, 23 level. And so this actually might, if you're patient, this might be not a terrible entry level for silver. But generally, silver likes to tease us, and we think there's an upside opportunity, and then it falls over again. As we can see, these are weekly candlesticks, and we've kind of been trading around, chopping in a range for quite some time. So similar to silver, if you don't want to be patient with it, I think I'd want to see at least a break above probably the 25.50 level, or even stronger yet, the $27, $28 level on silver would be a really bullish signal. But right now, there's a good chance that we just chop around in this 22 to 25 range. And I mean, that could really happen for 6 months, I'll probably know. And so, while this might be a tactical buy entry on silver, if you're not patient with it, then I'd probably just wait until we saw a little bit more bullish signal on silver. So let's jump over to the interest rates and see what we're doing here. Just huge moves in interest rates over the last few weeks. These are weekly candlesticks. Our 2 years back up to about 2.5%. We haven't been at that level since 2019, so it's been quite a few years since we've been at this level. And we'll just keep an eye on this and see where we're headed. It wouldn't surprise me to see us get up to that 3% level, and then that might be an opportunity where it starts to roll over or slow down. But I think at least for now, the bias is clearly still to the upside on the 2-year Treasury bonds. When we jump over to the 10-year, we broke above a key level here at about 2.65. We closed the week at about 2.7. Looks like we're still going higher likely on the 10-year. I think we're getting pretty close to a potential top though on the 10-year. If you're a bond trader, I think if we peak out at about 3 to 3.27, those are two levels I'm watching on the 10-year pretty closely. And if we see it roll over from either one of those spots, then that could be a signal to look for some bond trading opportunities. Bonds have just been beaten up really badly with this aggressive move in interest rates. And so if we do see a rollover in interest rates, start to see them go back to the downside, that could be a really good opportunity to get some bonds on the cheap and potentially make some bond trades. And when we jump over to the 30-year, we broke above a key level we were watching at the 2.43 level. Just this week, 2 weeks ago, or a week ago, we closed down and held that as support, and then we had a very strong move to the upside. Went from 2.43 to 2.72 in just 1 week, so that's a very big move on the 30-year yield. And then we jump over to the yield curve, taking a look at the 10s minus the 2s. A lot of talk around it getting below the zero line last week, but we had a pretty strong move back to the upside. And so within a week, we literally got below the zero line and are already back up to the 0.184 level. And so we'll want to watch that closely. I talked about one of our short videos we did on the yield curve. Typically, you want to see for a stronger signal, when the yield curve inverts, you want to see it invert for a period of time and not just for a week or two to get a much more reliable and stronger signal. And so we clearly didn't get that this time. We'll want to watch these levels closely and see if we re-invert. There's been a couple other times in the past where we inverted, got back up above the zero line for a while, and then sold off on that yield curve ratio and then stayed below zero for quite some time. And so we'll be keeping our eye on that. But for now, I don't think there's too much to worry about as far as the whole yield curve story until we get back below that zero line and stay down there for a while. And when we take a look at the VIX, we actually had the VIX dropping down quite a bit this week. We did see a bit of a spike about 3 days ago where it got all the way up to about 25, but then the last couple of days it really sold back off, and we just about closed at 20, but ended up finishing up the day on Friday at about 21. And so the VIX I think if the stock market was going to aggressively sell off right away, I think we'd see a much larger spike in the VIX. And since we haven't seen that, that's also one of the reasons I'm thinking that there still might be a chance for a little bit more upside in the markets before we see that correction that everybody seems to be getting ready for. And let's go ahead and close it out with a sector breakout. We've talked about energy all year. It's been one of my favorite sectors to trade off of. Although March was really a pretty bad month for the energy space, kind of really went sideways or corrected even a bit, but we've seen that change recently, and we saw the XLE break out. Actually today, where it got above, on Friday, it got above the 78.65 level and closed up there above that at about 79.50. So pretty strong breakout for energy. And we're up in that level we're watching. The reason we're watching is because those were the former highs in the 2016-2017 time period. And so if we can stay above that level, then it's likely moving to the upside, and I'd probably put the next price target on the XLE at about 101.50 cents or so. And so we're looking like there's some good trade opportunities I've already been looking for. A few stocks to get into. I picked up Devon Energy today, also picked up some Halliburton calls, and so it's starting to look like there could be some nice upside momentum back in the energy sector. And I think just broadly, the energy sector is likely going to be one of the best sectors for the year broadly, and so I think that's still one of the best places to be looking for long opportunities. Make sure to download Toro Alerts app on the App Store, and you utilize the promo code so you can get 1 free month. And make sure to tune in next week for our next weekly update. Thanks for tuning in. We'll see you next time.